All right, so I'm going to be starting the read of the Wyckoff course. So I think a lot of folks want to learn the Wyckoff material. So we'll just start. Please note that I'll be going through it pretty much line by line. So this is a pretty big endeavor. Um, and let's just start. All right. So and stuff that's fluff or just you don't have to read every single thing, but the majority of it I will go through. Anyway, what he's saying here is go through it 3 times, for example, in this page. All right. And then he's saying that, once you go through it 3 times, practice with the position sheet. All right. The first time you go through it, um, with a casual read through it entire second time, uh, taking a look at the notes, the footnotes, and all of that. This is when you start absorbing the material. And mark any paragraphs that are important. Now study section 4M and 6M and practice making the vertical line chart and figure charts. So 4M and 6M are just charting, I think. And then there is no coaching staff. Study again 5M and 7M, and basically you got to go through it multiple times. All right, that's just the way this course is. It's not it's not a YouTube video. All right. Um, all right. After that, start doing the work, meaning in terms of creating a position sheet. After that, do paper trades. This is pretty good guidance. I mean, imagine you have to go through it multiple times so you absorb it. Then you start paper trading. I mean, that that is something that's true today also. You hear that, why did you all start trading without paper trading? And that's basically what leads to massive losses because it's a progression. It's not, from zero to hero. All right. So you conduct paper trades after you've completed all of that. Ooh. And then you start trading. All right. I'm not going to go through this. It's a forward, but basically saying that you can apply it to any market. All right. You can apply it to the bond market, stock market, commodity market. Yes, it goes on currencies as well, forex, and all of that. All right, and next, basic law of supply and demand, judging the market by its own action. It's all about judging the market by its own action. Why? Because when you judge a market by its own action, you're not influenced by all the lies and stuff on online. And second is typically before a large move or a significant move, there's always preparation. Not always, but majority of times, or you have some tip-offs. So those tip-offs are in the chart itself. You'll be seeing accumulation before markup. And the signature of accumulation is high volume. So you'll be seeing high volume before markup. Or like sign of strength, and before sign of strength, you'll see some cause. So that's basically it. You're judging the market by its own actions, the inability to go down, rejections, shakeouts telling you it's going up, right? Or there's a lot of effort on the upside, meaning it's going to go down because it's too hard to go up. Bottom line is that you judge a market, what it's going to do, or you forecast it based on current behavior in that market itself and its price volume behavior. All right. The volume is of great importance. Yes. What does it do? To measure the force of the buying power, selling power as shown in the number of shares. the power, the buying and selling power. Um, all right, it's buying and selling power. Whether it was buy without advancing prices or to force the prices up or to mark it down or to discourage. I mean, yeah, there's a lot of things to be said about volume. All right. Oh, look, there's a reference to market psychology. That's funny. Continuing my studies of tape, I realized that the basic law of supply and demand govern all price changes. That the best indicator, here you go, about forecasting. The best indicator for future course of market was the relation of supply to demand. Best indicator of future was the relation of supply to demand. We'll talk about that later on. We get into waves, meaning up wave versus down wave, up wave versus prior up wave, down wave versus prior down wave. The law of supply and demand operates in all markets. And even in other markets, real estate, labor, etc., commodity markets. A lot of folks saying, oh, Wyckoff is only stocks. This is incorrect. I don't know. I mean, look at what this says. This is true not only of stocks, it is constantly being demonstrated in markets like wheat, corn, cotton, sugar, and other commodity markets, and even real estate and labor. So I don't know where this idea comes from that it's only for stocks. It's just, I mean, the course clearly says it isn't. Coming events, I claim, were foreshadowed on the tape because large interests there disclosed the anticipation of advancing declines by their purchases or sales. So too, the manipulator was endeavoring to raise or depress prices. If only, okay. The trend. What is the trend? The trend was simply the line of least resistance. There you go. The line of least resistance. And how? I claim tape because large interests there disclose their anticipation against another indication about forecasting a price by their purchases or sales. I'll give you a hint. When the market is going down and it hits a support level and all of a sudden the volume increases on a huge up wave, it's buying from support, right? So put that in context here. They disclose the anticipation of advances or declines by their purchases of sales. So that big wave at the bottom is forecasting a trend, basically markup. The sign of strength is forecasting the ensuing markup. All right. What is trend? Line of least resistance. All right, this is good. The critical moments of all these various phases of the market were the minor and major turning points. We'll talk about the minor and major turning points as well. Here's another point. In fact, the forecast contained in this letter was so accurate, meaning high probability trades, that a large following was developed. So it's highly successful from the standpoint of profits realized for his subscribers. All right, let's just go. Judging the market by its own action, the business of Wall Street. All right. Tape reading and chart reading enables one to detect and profit by these inside operations of manipulation to judge the future course of stocks by weighing the relation of supply to demand. It's very important that you're able to do this and acquire this ability. That's why it's not a pattern. It's being able to judge supply versus demand. It's very dynamic. And it can be done by price movement alone. Like from the perspective of distance and time, actually, time and distance, it can be done on price movement alone. So it can definitely be applied for Forex. But if you consider volume, you get an additional and vitally important helpful factor. So it's price, time, and volume. Here's a very, very, very important point. Study your charts not with an eye of comparing the shapes or of the formations, but from the viewpoint of the behavior of the stocks and the motives of those who are dominant in it, and the successes and failures of the buyers and sellers as they struggle for mastery of every move. You're basically saying, you can't just use chart patterns. All right. What do you use? You have to use judgment. What are you trying to do is gauge supply versus demand, the pressure of each, and then make a judgment of whether it's going to lift or fall, and certain key behaviors. What type of behaviors? Effort, reward. What other type of behaviors? Shakeouts and springs and upthrusts. Why? Because basically springs and upthrusts are minor shakeouts. That's what they are. And the motives. All right, what's the motive? Well, this is a stop run. Okay, now if it makes a higher high after a stop run, that is giving you a key indication, right? So those are the type of things you're trying to understand. Not, okay, this looks like a head and shoulder. So what are you using when you judge? Price movement. What is that? It's the distance or the high to low, the range or the spread, or in terms of a wave, the low to high, the swing high to swing low. Basically, the amount the price has moved up or down. That's price movement. That's a key factor. Second is volume. What is volume or the intensity of trading? Number three, the relationship between price and volume. And number four is the time. So basically, price, volume, and time, right? And the relationship of the up waves versus the down waves, or the up bars versus the down bars. So again, what are they? Price, volume, and time. And I'll explain time, but time has to do directly with what's called speed. So it's basically how much price moved in how little time. That is speed. And we'll talk more about that in a bit. I don't want to go into this too much, but it's types of charts. You need you need capability of point and figure. You need the capability of wave chart, and you need a bar chart. That's it. Okay. Here's another point. Most of people don't like charts and this and that. They become mechanical, meaning without judgment. Using arbitrary rules or systems such as oscillators. You see, even in Wyckoff's day, there were oscillators. See this? And he frowned upon them. He frowned upon diagrams, patterns, and oscillators using rules. So I'll give you an example. This average crosses that, or MACD, where you have that that the cross, or you have some folks use trend lines on RSI, and they look for a break. So these types of arbitrary rules, such methods are wrong. They lead only to errors, losses, and discouragement. When you study charts, look for the motive behind the action which the chart portrays. Aim to interpret the behavior of the market and of stocks, not the patterns. So this is totally different than what we're doing. A lot of people are doing is looking for patterns, right? So this type of approach, the Wyckoff approach, is totally different. Imagine you're looking at a chart and trying to figure out a motive, right? Is there no wonder that a lot of Wyckoff traders look at springs and upthrusts? They have motive, don't they? It's a stop run, right? So you're looking for that motive, or climaxes, and looking for that transfer of inventory from weak hands to strong hands, or a false breakout, basically upthrust. So the motive, especially on these behaviors, or when there's a lot of effort and they're selling, but the price isn't going down. So these are there's these maybe you should create a table, like behavior, write down the behaviors, what is their motive, and a lot of inducement also. When the market goes up, pulled back very little, and then continues to go up, then what happens? It comes right back down to take people out. So what is the motive there? The motive there is inducement, meaning you want people to get in so they can cover and create additional buying pressure. When markets pull back, that's what happens. When they pull back, they induce individuals to sell. Why? So when they reverse, the selling pressure and the covering causes for a bigger move. All right, here's the point. He worked with a lot of stocks. We're going to work with futures. All right. And you need to have a wave chart. So in this method, we use three kinds of charts. Bar chart, we mean open, high, low, close, or just high, low, close, right? That's your vertical line chart. Second is your figure chart. If you don't have a figure chart, there's a problem. So you gotta have a figure chart. And three is the wave chart. Yes, they're just a wave chart. Almost every platform has these. So what platforms? You have Sierra chart, you have TradeStation, you have IRT, you have what else? Market Delta, I think. Uh, there's so many platforms that should have these charts. I don't know. You can use whatever you want. All right. Next is hmm, All right, so volume, we know that that has to do with intensity of trading or buying or selling power. Time, speed, it's all about speed, whether it's urgent or leisurely. So, is how quickly is it moving? Is it urgent? So what do weekly and monthly charts do? They give you the general trend, but the daily will give you the turning points, and it's much more sensitive. See, timing commitments and recognizing turning points. So again, what do you use for trend? Weekly charts. You're going to see a big difference if you move to weekly charts for trend, especially with stocks. Stocks look very choppy even on a daily chart. But as soon as you go to the weekly chart, you see very cleaner movement. So again, the trend, weekly chart, the turning points, daily chart, timing a commitment, daily chart, turning point, daily chart, trend, weekly chart. And also the timing of commitments. It's not just the daily by itself. It's also going into the lower time frames and using the wave charts. So I'll be showing all of that, and I don't think it's been shown or explained on, at least not on YouTube. But we'll be going through that. And figure charts. What do we use figure charts for? Uh, Estimating the move. So this I have to, and as well as point resistance. But I'm going to be modifying the figure chart a little bit because for futures it's not practical to use one point, because I mean, markets there's some markets that are very low priced. If you look at, I think, copper, was it, or nat gas, so you cannot use a dollar. And then there are markets that are very high priced, but there are things that you can do, and be modifying the point figure specifically for the futures markets. Here's another point here. From the general formations, which are popular with purely theoretical technicians, again, he's saying don't use general formations like saucers, baskets, or fulcrums on the point and figure chart. Right? Instead, the figure charts are able to detect accumulation and distribution. That's very, very important. And we can see clear lines of supply and support. We can identify markup, markdown. What's the most valuable thing about them? They're horizontal formations. Why? Because they tell you how much the move should go. So with a certain degree of accuracy, not 100%, not even 90, say they would give you a high degree of probability that if a base has 10 points, that it's going to rise at least 10 points. And with the help of a vertical chart, you'll be able to determine the trend when the stock is on the springboard. It's very important. All right. And these are different types of figure charts, but generally 1 by 1 or 1 by 3. Now he talks about trends and says there are two types. What are they? There's the immediate trend for active traders who want to get in and out. Those are the small time frame trends. And then the trend of the intermediate swings, which includes most of the managed campaigns. What intermediate swings? 5 to 30 points. These include most of the managed campaigns. This is what you're going to target. Imagine being able to identify a campaign, jump on board, and the thing goes, say, 15 points, you know, and then being able to do that a couple of times. That's really awesome. We're not going to be doing all this. It'll just be a position sheet of the futures. All right, but I mean, for those who do stocks, it's really important to have sectors and then groups and all of that. But it's pretty exhausting to do all that. So vertical charts are essential for the proper timing of commitments and especially detecting the minor turning points. Because there are times when, yeah, you can't use figure charts for that. Wyckoff wave was invented by him in 1916. It's over 100 years ago. What does it do? It gives a graphic representation of the day's tape action. And shows you the change from strength to weakness and the turning points, not only of the minor but the intermediate swings. That's pretty damn important. Then he talks about group charts that have to do with industries. This is really important if you're a stock trader. Why? Because take a look at groups, right? They don't go move at the same time. If you're looking at groups, you'll see one moves before the other, and that is a tip off. Same thing with stocks. You'll see that there's a tendency of there being leaders and not moving at the exact same time, which does offer an edge. Even with the futures, you'll see like the NASDAQ sometimes move before the ES. So why is that? Definitely move before the Dow. This is very important. I'm going to skip this. Basically, says you got to learn how the wave chart, thinking in waves, and being able to judge the rally versus the pullback. And how you do that is you do it based on distance. You also do it based on volume and time. All right. Here's a very interesting criteria. Like if you consider yourself a Wyckoff trader, here is something to judge yourself by. Your education will not be complete until you can cover all your shorts and go long at the bottom of a panic. All right. Basically, you need to be able to catch a falling knife. Oh, maybe not a falling knife, but you need to be able to go long at the bottom and short at the top. All right. Your education will not be complete until you can do two things: buy low and sell high. Not going to be going into chart records. We have trading platforms that do all that now. All right. So we're at this point right here, section 7M. I'll start on this hopefully soon. And you'll see how I do this. What you want to do is get ready for this piece, because it's been described as his most brilliant work. All right, I'm done. Have a good night. Bye.